This is the final segment in our three-part series on the Infrastructure and Development Bond Fund and its 30-year track record. My name is Vuyo Nogantshi. I'm the CEO at Futuregrowth, and once again I'm joined by Jason Lightfoot, Senior Portfolio Manager at Futuregrowth, as well as Daphne Botha, Portfolio Manager and Head of Risk Management at Futuregrowth. Welcome, team.
Thank you.
Thank you.
So in the first two segments, we've covered where this fund came from, the actions and learnings that we've had along the way. Now we look forward to South Africa's infrastructure financing gap, which is estimated at over 2 trillion rand across the next 2 decades. Water systems are failing visibly. The energy transition is creating new investment opportunities and new structural risks. And retirement fund allocations to infrastructure remain in the low to single digits, despite regulatory room to grow. The question is what needs to change for institutional capital to flow at the scale that the country needs. Jason, I'm going to start with you today. The government recently issued a sovereign infrastructure bond. The president committed to establishing a fully independent transmission entity separate from Eskom. Futuregrowth has publicly supported that commitment. Do these moves signal a genuine shift in how South Africa finances infrastructure, or are we still at the stage of policy aspiration than investable reality?
Thanks, Vuyo. Yeah, I tend to agree that these are encouraging signals. We definitely are moving in the right direction. But policy aspiration doesn't necessarily equate to investable reality. REAP, as we referred to in the previous episode, was ultimately the gold standard. It was definitely where all the stars aligned, where the 9 bankability requirements were all met. And it's very important that we should be able to replicate that across transport, water infrastructure, social infrastructure, to allow us to make those deals bankable. I think the concern that I have is that the pipeline of deals aren't growing enough at the pace that the country needs.
And I see a lot of commentary that you put out, Jason, on this particular matter. Maybe I'll just jump to you, Daphne, from a water infrastructure perspective. It's arguably the most urgent crisis facing the country. We see a lot reported on it. Aging pipelines, poor maintenance, limited municipal capacity. Recent protests over water outages in Gauteng made the service delivery failure impossible to ignore. From a credit and risk perspective, what would it take to make water infrastructure investable for a fund like the IDBF?
So if I go back to our previous 2 sessions, bankability would be one key thing. Water is a bit tricky though. Water investment is primarily done via the municipal framework. And as you might know, most of our municipalities are not performing as they should. So it becomes a really hard thing to co-fund or to sort of co-invest alongside a municipality. And the regulations doesn't really allow us to do that in a quick, transparent way. What we need in water actually is something similar to the REAP program. We need a public-private partnership originated by government. Because of the regulatory hurdles that we have to jump through, government has to be a player in it. And as I said, because this relies on municipalities to perform, I think there's going to be many high hurdles for us to jump to make these deals bankable. Currently, the city of Cape Town stands out as one of the few municipalities where you could consider that. But the need is, as you mentioned, in Gauteng. Currently, most of our water investments is, one of the big ones anyway, is the Lesotho Highlands Water Project, which actually provides water to the Rand Water Board, amongst others. And it's just not enough. I just feel like there is not enough thinking, there's not enough intentionality around water investment currently. It needs to come from government as a first start, and then it needs to be made bankable.
And staying in the vein of allocation, Jason, if we move to just retirement fund allocation, so not ourselves, but our clients, infrastructure sits in a low single-digit allocation as a proportion of total assets. And the regulatory framework allows for significantly more from these investors. So the capital is there, the need is there, yet allocation hasn't moved. Where do you think the bottleneck sits? Is it with consultants, the trustees, or ourselves, the asset managers?
I think neither of those. I think it comes down to the premise of lack of sufficient bankable deal opportunities. Sure, I mean, even though the allocation is low, but it's primarily driven by that low supply of bankable opportunities to fund and find their way themselves into those retirement funds. Sure, there is some level of education that's required, and we do a lot of that through trustee training events, engaging with consultants, through our engagements through bodies like a CISA, to ensure that the word gets out there. But ultimately, it comes down to bankability of deals.
And it's a slow burn there. I mean, Daphne, when you speak to trustees and you're thinking about this infrastructure allocation, do you have any anecdotal views on what the objections you hear most often? Is it a reality or is it a perception gap?
I think we might have done too good a sell on, selling the infrastructure bond fund as a bond fund and not as the infrastructure fund. I think things like state capture and, the demise of some of our state-owned enterprises has not really helped the cause or put trust or faith with our trustees that these deals will add to their returns. I think there is still also a myth that, these are subsidized transactions and they're not going to give us the returns we need. So there's still a lot of myth. Jason talked about trustee education. I think we need to do a lot more to get those allocations higher.
And Jason, just coming back to the, alternative channels, development finance institutions, the DBSAs, the IDC, the World Bank, these all play a role on the first layer of risk that institutional investors like pension fund can come in behind them. That is the idea behind what we call blended finance, mixing public and developmental capital with private capital to make marginal projects more viable. What does a good blended finance structure look like from the perspective of an institutional investor being asked to come in alongside a developmental funder?
Yeah, I mean, it's very deal specific. It depends on the underlying deal, what level of underwrite do you need, what level of first loss capital do you need to be brought into the transaction. I mean, an example that I can bring into the room in terms of a deal that we funded many years back, I think it was 2006, where we provided funding to Capitec. I mean, Capitec was at the start of their journey, and they required funding from the markets. We did a small 50 million rand loan, and it was backed by a US aid guarantee. And it made that deal bankable at the time. So ultimately, it's bringing to the fore that Futuregrowth are experts in the space. We have a long-term track record. We have strong credit expertise, and we engage. We're not a backseat lender who just sits on the sidelines and doesn't engage when things go wrong.
And just staying with you, Jason, if you look at the energy transition, it's about creating new infrastructure opportunities from battery storage to transmission and distribution. At the same time, it creates standard asset risk for older infrastructure that's tied to fossil fuels. How do you think about the energy transition as a portfolio construction question? Is this primarily an opportunity, a risk, or both at once?
I think it's probably a combination of both. From an opportunity set point of view, from an RRP pipeline point of view, you've obviously got opportunities existing in battery, further REIT-related opportunities. You've got transmissions coming on board. And given our experience, we've obviously would know how to approach the risks that are inherent in these transactions. We're also quite deliberate in terms of our fact that we aren't funding any new coal-fired plants. But I think the risk for me is from a grid point of view that there's not true independence, where Eskom acts as both the referee and player at the same time, which doesn't really create a nice sound playing field for all players within that market.
And with 3 decades of renewables experience, do you think that positions us as differently from competitors who may be entering the space today?
I think so. I mean, initially I did mention that we're quite familiar with how concessions are meant to be structured and what the risks are inherent in them through our toll road investments in the early days, and that we brought through to our initial analysis of the REIT program. So I think given that 30 years worth of track record and experience definitely places us in a good position to play a meaningful role in these opportunities.
Maybe just testing then, Daphne, how you continue to be as good as the firm has been in this space. You coordinate the portfolio manager preparation program. which is designed to build the next generation of investment professionals at the firm. What does the pipeline of future portfolio managers look like? And is there something specific about infrastructure investing that requires a different kind of training than traditional fixed income?
We are running a portfolio manager training program. We've got 3 trainees currently in process. 2 of those actually are quite close to the infrastructure space. They're credit analysts by nature. Does it require different training? Not specifically. So the base program is just standard fixed income portfolio manager training. If you think about a infrastructure deal versus a normal bond, all we're talking about is a series of cash flows. At its base, it's everything can be broken down into a series of cash flows. And so from that perspective, fundamentally, it should be no different. What might be different is when we do the on-the-job training part of the program, where we pair up the trainee with a seasoned portfolio manager. We expose them to those specific funds that have infrastructure investments. And so that gives them a different view of portfolio construction compared to a vanilla fund that only invests in government bonds. How you look at the risks in those portfolio are completely different. In a government bond portfolio, you're not necessarily worried about credit risk. You've got sovereign risk, risk-free portfolio. Whereas in a credit portfolio, you're worried about that 0.23% exposure in that fund that might default. So that comes through in the on-the-job training component of the program.
Good. And if we go back to a younger Jason, I would have said baby Jason, but that would be too long back. Tell yourself one thing about managing infrastructure debt. What is that thing?
I think the importance is around patience and being able to embrace the pace, because infrastructure investments take a long time. It's not a case of just buying a quick little listed instrument on the JSE. They take years to structure, years to draw down, and you need to monitor them over a multi-decade period. So therefore taking a much longer term horizon in terms of your approach.
So we started this conversation speaking about a thesis that a young student convicted thought you could get commercial outcomes while being developmental in your investing. We've spoken through the portfolio process, the risk management process, and really where this particular space of investing is going. But the question is, over 30 years, you get a good chance to see whether the thesis holds up. So to both of you, has the thesis held up? Or are there areas that you think it could have been harder than you expected?
Definitely, Vuyo. The thesis definitely held up. The funds outperformed its benchmark by at least 1.75% over the last 30 years. The developmental impact is there. The discipline survived. Sure, there are concerns from a current environment point of view where the pace of opportunities for the fund aren't where they should be. It's not meeting up with the needs of the country. But I do quite enjoy the fact that when we sometimes take clients on deal tours where they actually see the real impact of the opportunities that they are investing into. So for example, showcasing a affordable housing solution where you then showing the real impact of allowing somebody who used to travel 50 kilometers one way to arrive at a place of work, now they're just down the road.
Mm-hmm. Daphne?
Yeah, from my perspective, I mean, Jason said most of it. The thesis definitely holds. I think the thing that gives me pride is presenting on the fund, seeing how our clients perceive those returns and how it warms them. But also it makes real impact. Remember, we're working for pensioners who wants to retire with dignity. And so I think this fund gives them that opportunity to do that.
Thank you, guys. As we come to the end of our 3 conversations, we've covered where the fund came from, where the fund has learnt along the way, and where the fund is headed into the future. The founding idea that you can invest well and invest purposefully has been tested by every kind of market, political and institutional pressure over 30 years. The returns that matter are not just the numbers. They are the schools, the toll roads, the power plants, and the housing and the capital built. And they are the discipline and the people who made sure that capital was protected. Thank you to Jason and Daphne for your time, and thank you for joining us.